In this video, we're going to discuss the concept of trading with the trend. The first step in identifying the trend is to have an indicator that is geared to being able to identify major moves in the market. What we have selected to do that is either the use of a MACD or a stochastic on the large S&P contract. We set the tick interval to either 45 or 100. On the chart, the lower stochastic is set to a 45 tick bar large contract. Using this approach makes it easy for us to identify the trend. Once we have identified what the trend is, the next step is to use a shorter tick interval on the large contract, such as a 3 or a 5 tick. That's represented here by the upper stochastic. Here we have a 1000 tick bar ES chart. It's very easy now to identify oversold conditions. The trend is up and we want to buy into that move. Our opportunities then to trade are going to be right in here, or here, in here, or in here, or perhaps in here. Look at how that works. Visually, it's very easy to see. Using a large contract for the purpose of tracking what the major trend is, and then a shorter tick interval that becomes oversold, will place you in the trades at some very prime opportunities. Let's take a look at a short. Here we have the large contract sloping down. So now what we do is we look for overbought conditions on the faster tick bar interval. We have those conditions right in here. And ultimately we get a big move down. Once that move begins, when the large contract shorter tick interval once again becomes overbought, we have the trading opportunity here, or here, or here. Here doesn't work so well, but it works here, and it certainly works here. What could be easier? These opportunities are very, very good. All right. Now, to aid us even further, what we're now going to do is add the premium into the equation. We're going to take out the stochastic that shows us the trend and instead replace that with the premium. Now we have the premium showing in subgraph 2, and we have two horizontal lines showing certain thresholds that have been pre-calculated by our strategy. These thresholds, when exceeded, and when the trend is down, identify for us the specific opportunities for entering the short sale. Here, as the trend begins to move down, Notice how the premium spikes up right here, and then again here, just to that line. It happens again in here, as well as in here. Again there. Several opportunities take place there. Another opportunity here. It moves right into the line there. Now as the slope of the indicator is going up, once again we need it to get close to an overbought condition. And notice how the premium moves up very strongly right in here, but that's an opportunity to short. And then again right there, right in here. So these various opportunities are based upon the use of both the overall trend, a faster stochastic, and then spikes in the premium. Let's take a look at opportunities for buy signals. Now watch as we identify these opportunities where the overall trend is up and so is the stochastic on the faster tick interval. The low of the premium drops into the threshold here. Next opportunity, when the trend is up, it's going to be right there. Trend is already up, premium drops. Very little risk. In here, but not here. Trend is down. Another opportunity, right in here. Trend is up, premium bars, just make it to the line, and up we go. So that's how we identify, that's the concept that we're using in the strategy. And in our next video, we're going to show you some actual trades that are based upon this concept.